What happens when the Bank of Canada decides to cut the key interest rate, and how does it affect multifamily real estate investors across Ontario? Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. In a recent development, the Bank of Canada has reduced its key interest rate to 2.25%. This change, as reported by Global News, could bring potential relief to borrowers and mortgage holders, but its implications stretch far beyond just the housing market. Personal finance expert Rubina Ahmed-Haq delves into what this rate cut could mean for everyday Canadians. For multifamily real estate investors, this interest rate cut might open up opportunities to refinance existing loans at a lower cost, potentially increasing cash flow. The reduced rate can also make borrowing more accessible for new investments, which might be particularly beneficial in cities like Hamilton, Niagara, and Kitchener-Waterloo, where real estate markets are active and competitive. However, it's crucial to consider the broader economic context. While lower interest rates can stimulate investment, they can also reflect underlying economic challenges, such as slower growth or inflation concerns. For multifamily investors, staying informed about these broader trends is essential to making savvy investment decisions. Despite potential economic headwinds, it's important to focus on the positive aspects of this rate cut. Lower borrowing costs can enhance investment returns and provide a buffer against potential market volatility. By leveraging these lower rates, investors in Ontario's thriving multifamily markets can position themselves for long-term growth and success. According to a recent Yardi report, Canada's multifamily real estate vacancy has reached a new 5-year high for the second consecutive quarter. The vacancy rate increased by 110 basis points year over year to 4.3% in the third quarter, rising from the half-decade high of 4.1% recorded in the second quarter. This trend highlights a shift in the market dynamics, as reported by Monty Stewart. Interestingly, Montreal experienced the most significant vacancy increase in the third quarter. The rate climbed by 1% year over year to 5.6%, driven by a 3.3% rise in the market's purpose-built rental housing inventory. On the other hand, Calgary maintained the highest vacancy rate at 5.8%, though it saw a notable decrease in vacancies by 90 basis points quarter over quarter. Meanwhile, Winnipeg and Halifax reported the lowest vacancy rates, at 2.4% and 2.8%, respectively. Despite these increases, the market remains healthy, according to Yardi, even as the Canadian economy faces challenges from rising United States tariffs and weakening employment. The report notes that Canada's multifamily market is sustaining moderate rent growth and strong demand in most regions. The report also highlights that former market leaders like Calgary saw lease-over-lease rents fall by 3%, with the average bachelor unit vacancy reaching 6.7%, the highest among all unit types. Toronto's bachelor suite vacancy rate was particularly striking, standing at 8.9%, well above the national average. On a positive note, the average national in-place rent increased by $14 to $1,734, although the annual growth rate decreased by 90 basis points year over year to 3.9%. Halifax, benefiting from its burgeoning technology sector, recorded the highest year-over-year in-place rent increase at 5.9%, a $29 rise to $1,634. Other cities such as Edmonton, Saskatoon, and Montreal also reported strong rent gains, while Calgary, Ontario's Kitchener-Cambridge-Waterloo region, and Toronto experienced the lowest increases. Halifax again led in new lease rent increases at 4.9%, with Ottawa, Gatineau, and London, Ontario tying for second at 4.3%. Conversely, Calgary faced a 3% decline in new lease rent growth, with Hamilton, Kitchener-Cambridge-Waterloo, Toronto, and Vancouver also performing poorly in this regard. These dynamics underscore the importance of location and market conditions in multifamily real estate investment and highlight the need for investors to remain vigilant and adaptable to these evolving trends. In recent news, Allied Properties Real Estate Investment Trust, one of Canada's largest publicly traded office building owners, has seen its unit price fall by 17%. The decline follows management's indication of a potential distribution cut, as reported by Tim Kaladze. This comes amid weak leasing figures and ongoing challenges with a substantial debt burden. Allied Properties is known for its low-rise office buildings in downtown cores, which have been under pressure due to muted office leasing activity compared to pre-pandemic levels. The company has been facing questions about its monthly distribution for some time, with annual payouts totaling around $250 million. Despite previous assurances of sustainability, management is now considering a distribution cut to strengthen their balance sheet. The shift in Allied's stance was prompted by a challenging leasing environment, which has affected their cash flow. While they had initially projected achieving 90% occupancy by year-end, this target has been pushed back, with year-end occupancy now expected to be around 84%. This shortfall not only impacts cash available for distributions, but also reflects broader market challenges. Before the pandemic, Allied's low-rise buildings were highly sought after by businesses in the creative and innovation sectors. However, with a national vacancy rate for downtown Class A office buildings at 16.1%, as reported by CBRE, the landscape has changed significantly. The anticipated boost from return-to-office mandates has not materialized as expected, further impacting Allied's leasing outlook. In addition to leasing challenges, Allied is grappling with debt issues. The company had aimed to reduce its debt level to 10 times earnings before interest, taxes, depreciation, and amortization by the end of the year, a target they now acknowledge will not be met. This has been a persistent issue for Allied, despite efforts to alleviate it through asset sales, such as the sale of data centers in downtown Toronto for $1.35 billion. While these developments present challenges, they also underscore the importance of adaptability in the commercial real estate sector. Investors and industry stakeholders must keep a close eye on market conditions and be prepared to adjust strategies as needed. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.